This is your LMAX exchange technical update for Monday, January 23rd, 2017. Euro dollar. So the euro continues to trade higher over the past several days, and the market could be threatening what is an underlying downtrend. At this point, though, when you look at the chart, we still haven't compromised that downtrend with that 108.75 December peak still well intact, and the market potentially still looking for a lower top ahead of a bearish resumption. That 108.75 December peak also coincides with the top of the daily Ichimoku cloud, and a break above the cloud would be required from that perspective to signal a shift in the trend. So while we are seeing a push higher in the euro, it still is focused on the downside while we trade below 108.75 and below that top of the Ichimoku cloud, which coincides with that level. Ultimately would take a close back above 108.75 to take the pressure off the downside. Until then, there is still risk for a fresh downside extension to retest and break below those recent 14-year lows down at 103.41. Sterling dollar. So cable is showing signs of a potential base after the market put in an impressive recovery in the previous week. The pound is outperformed across the board over the past week. A break and close above 24.33, a recent high that we saw going back to the 5th of January, would be a significant short-term development and could open the door for more upside, suggesting or strengthening the possibility for a major base in the pound. At the same time, if we're unable to establish a close above 24.33, it will keep the pressure on the downside, and another move back towards those recent lows that we saw in the 120 area just below 120 should not be ruled out. Dollar yen. So dollar yen has seen a bit of a consolidation over the past few sessions. The market is overall correcting off the recent highs that we saw at 118.67 going back to December. There has been a shift in this structure over the past several months, and so it does favor the top side, and this pullback that we're seeing is viewed as corrective, ultimately in favor of that next major higher low and bullish resumption beyond the recent multi-day highs, multi-week highs at 118.67 and through 120 further up. At this point, though, any setbacks that we do see could still go down towards some previous resistance turn support in the 111.45 area. Euro Swiss. Euro Swiss has been trading in a tight range over the past several days. The pressure here does remain on the downside despite the slow go here, and a retest of that 2016 base at 106.24 is favored. Really, it would take a break back above 109 to take the pressure off the downside. On a short-term basis, a break back above the 107.60 area would be required to alleviate immediate downside pressure. Aussie dollar. So Aussie has seen a very impressive run since December, with the market trading back above 75. But if you look at this chart going back on a medium-term basis, rallies are very well capped here. And so if we do see an additional push this week, it should be well capped, well below 78. It would take a break back above 78 to sort of reconsider this structure, which continues to be sort of a sell on rallies and buy on dips for the time being. So we're getting close to that point now where selling rallies makes more sense in favor of a retest of medium-term support, which comes in at 71.45. Those are lows going back to May 2016. Dollar CAD. So dollar CAD is in the middle of a range that we've seen that was defined by multi-day highs at 135.99 and the recent base that we saw at 130.19, just ahead of that psychological barrier at 130. Overall, however, if you sort of look back, the trend favors the top side, and so at this point there's every reason to expect this trend to continue for a push through those 136 area highs and towards 140 further up. It would take a break back below 130, that psychological barrier, to sort of force a shift in the outlook and potentially put the pressure on the downside. Kiwi dollar. So despite gains that we've seen in Kiwi since late December, the market here looks to be putting in a top at that 2016 high that stalled just shy of 75, and so a lower top is favored around current levels ahead of that next downside extension back towards medium-term support from back in May in this market at 66.76. SPX 500. The S&P 500 is at an interesting position right now. The market is, on the one hand, consolidating just off record highs, with that record run and the strong uptrend remain firmly intact, and so there is risk for additional upside beyond the 2280 area record high that we've seen going back to early 2017 and towards the 2300 and through there further up. At the same time, gains have been very well capped over the past several days, and so if we see a break to the downside that takes out 2232 support, which coincides with that low on the 30th of December, that would potentially force a shift in the structure, triggering what could right now be a double top formation. But again, it's premature to be talking double top, as this market hasn't even started to break down from recent lows. Initially, a break below the low that we saw on the 12th of January around 2254 would be required to maybe have a better conversation about a double top, and certainly again the neckline comes in at 2232, but it is something to pay attention to and should be watched over the coming sessions. Gold. So gold has been on basically a straight run higher since basing out by those critical lows that we saw back in December in the 1120 area. There are signs looking at the longer term price action that the support in the 1120 area still keeps alive the hopes of a longer term base carving out in gold, and so we could see now from here continued upside that eventually results in a retest and break of the 2016 peak at 1375, with dips now expecting to be very well supported. At this point, in order to negate that longer term basing outlook, the market would need to break back below that recent support that we saw in 2016 at 1122.75, but in the interim, any dips should be very well supported above 1160 in favor of continued upside in this market as it sort of moves back towards the next key resistance area in the 1250 to 1300 zone. So that's it for now.